Well, hello everyone. Welcome to the YouTube Live, and particularly to the people who've been supporting us on YouTube, in our YouTube membership. And hopefully we'll see some of you on the call tonight. We'll be able to tell because you have that beautiful icon by your name with Pension Craft with a little crown on top. So let me just start with a few points. And I think there was an interesting interview I did with Simon Dixon, and I've posted an excerpt of that. But several people said find out more about Bitcoin, and a good way to do that, obviously I've been looking at courses on Bitcoin, but a good way to do that is to speak to someone who's an expert. And I spoke to Simon Dixon, who was suggested by many of you as a good person to interview. And he's got a fairly broad background. He's worked in investment banking in the past, he's worked as a broker, he certainly understands things like fundraising, and he has really interesting ideas about money, which are quite unusual amongst, I'd say, your average person who's worked in the city isn't interested in money. They're just interested in getting their own money out of the city. But he has really interesting ideas. And so it was great to interview him. I certainly learnt a lot. Now, there was an excerpt which we posted where he talked about how to go through the process of taxation if you want to realize your Bitcoin gains, which was interesting. That's one of the reasons why he lives on the Isle of Man. And if you go for the Patreon membership, then you get access to all of our members only content, including the full uncut version of all these interviews. And in the case of Simon Dixon, the things which he discusses, which you'll also be able to see, is whether he thinks Bitcoin is going to replace fiat currencies or whether they'll coexist with fiat currencies. He'll also talk about the future of Bitcoin and also how to judge what the fair value of Bitcoin is, an interesting way to approach that. So I think you get a lot if you join us as a member. That's one of the things which you get. So if you are interested in that interview, then why not sign up for Patreon? You don't have to stay with us. We hope you do, but you don't have to. And it's very reasonably priced. I think you'll agree. This week, I'll be doing a video about SPACs because they've been very popular in 2020. 2020 is kind of the year of the SPAC. And if you're not familiar with them, they are also called blank check companies, where you find someone who you trust as an asset manager. They go off and invest your money in a company which isn't disclosed initially. And hopefully it's a very successful merger between their SPAC and that company. The SPAC injects lots of capital into the company, which can then grow and give you a very good return. At least that's a theory. The practice isn't quite as simple as that, as you can see in the video. Also, this is the last Q&A of 2020. We'll be back in January on the 7th. And so just be prepared for that dry period. You know, it's going to be awful without us, I know. And also thank you to the one person who disliked the video even before I started, and a genuine thanks to the people who liked the video before we started. It's nice to see. And if you do like this, remember you can always like the video, like the stream as we go along, and that helps us because the algorithm likes it, the YouTube algorithm. And yes, so some of the crowns have actually changed colour. If you look at the YouTube badges, they've turned turquoise because that means that you've been supporting us for a certain amount of time. A month, a voice tells me. Thank you, voice. Okay. But that allows us to remain independent. That's the point of supporting us. We could just, flog products that people tell us to flog, because we have many people now approaching us saying, will you promote our product? But one of the reasons why we don't do that, particularly for financial products, is because we want to remain independent. So being supported by you means it makes a big difference to us. So please do carry on doing that. And thank you if you already are a supporter. And also thank you very much for the people who've been helping us with the spammers, because we get a lot of spam on our channel. And let me just share with you one of the ones which I absolutely love. Let me just switch this to picture in picture. So this is a comment that was made from one of the spam bots. Esther Howard, which was obviously a spam bot, said, I tried trading Bitcoin once, but got discouraged by the constant rise and fall in price. And that's always a prelude to a stream of spammy comments. And then that's followed by a WhatsApp number to call. And Talbot Sunbeamer, who's, you may notice, is one of our supporters. They have a crown by their name, said, Esther Howard, you should use a fake fraudulent professional like Dr. Judy Fingers. She made me £30,000 from 2 bounties and a Vimto. And if not familiar with Vimto, that's a UK soft drink. But we've seen, lots of spam, which I guess is a sign of success, but one I'd rather not have. Here's another one, someone trying to flog their products in the comments. Now, if it's a reputable business, they wouldn't be advertising in the comments of a YouTube channel. That just means that instantly you should know that if a broker tries to contact you in the comments of a YouTube channel, it's a scam, right? There's no surprises there. Okay, so let's switch back to me and we'll start to think about the questions now. Okay. Yes, so thank you, Talbot Sunbeamer. That was a very amusing comment. And right, so let me have a look at those questions. Oh, goodness, we've got lots of questions already. Rushar, hi, nice to see you. Thank you so much for your educational content. I've learned a lot from you. That's great. You mentioned in previous videos you're concerned about defaulting companies. Is this still the case? Yeah, it's still the case. And so what we're talking about here is measured in a couple of ways. There are rating agencies like S&P, Standard & Poor's, Moody's, Fitch, and they also, what they do is they rate bonds. So they take a bond, they give it a credit rating. Another thing they do is come up with forecasts of default rates. So that's based on a whole bunch of different measures which they monitor. But if you look at the latest one, so let me just share my screen again. Here we go. And if we look at this Moody's document, so this is an article which they published on their website, on the S&P Global Ratings website, on the 2nd of November. And what they do is they show you the default rate currently. Now, this is focused on the leveraged loan index, which is based on very poor credit quality loans. That's what leveraged loans are. And they're speculative grade, which means they're sub-investment grade. And this is the default rate which they're currently seeing. So this is the 12-month default rate. Now notice how it's spiked quite considerably. It's still not where it was in the global financial crisis, where it reached about 8%. It's only at about 4.5%, maybe touching 5%. But that does suggest there is a credit problem. Now, going into this crisis, many people pointed out that leveraged loans in the United States had grown too quickly. They were over leveraged. The credit quality was getting worse. And that remains the case. So I'm still concerned that we're going to see more downgrades, more low-grade credit rating bonds defaulting, particularly in the sectors which are most hard hit. And here you can see them talking about COVID-19 vulnerable sectors. And of course, that would be customer-facing type of roles. And that would be things like leisure, food service, retailers, to a lesser extent oil and gas. But oil and gas is driven by the demand falling for gasoline because less people are driving around because they're locked down in their houses. And that's pushed down the price of oil. Things like hotels, motels, inns and casinos, whereas things like food products, electronics, building and development have been fairly unscathed. So it's always worth looking at those reports. S&P provides them for free. If you want the full-on S&P service, obviously you have to pay. But thank you, S&P, for providing that. Another thing to look at is a delinquency rate on loans. So instead of the corporate bond market or the leveraged loan market, here we're looking at loans made by banks. Now in Europe, a lot of the credit is funded with bank loans. In the US, much less. the US has historically been much more dependent on the corporate bond market. So if you want a loan in the US, if you're a company of a certain size, the default place to go for capital would be the corporate bond market. Whereas, Europe much more geared up towards leveraged loans, much more geared up towards bank loans. But the delinquency rate there on these commercial bank loans hasn't really picked up. So the latest update for this was Q3 2020. So the question is whether that's going to carry on. You can see it's a slight uptick, but it's nothing significant yet. And it's nothing like we saw in the global financial crisis. But notice how in the global financial crisis, it took a while to get its momentum up. So perhaps we're going to see something similar to that. And it still remains the case that credit conditions are tightening, which suggests that banks are more concerned about people defaulting. So I am still concerned about it, Rui, and I think it's worthwhile monitoring it because these credit effects can happen with a lag. And we've also seen it in emerging markets because, for example, Zambia announced that it was going to be defaulting on its sovereign debt. Now, that's not a problem for all emerging market countries. Many of them are still fine in terms of credit quality, but sometimes these things trigger a sell-off in many other markets. I think Zambia is too small a market in order to start a cascade, but if a larger country, such as Turkey, for example, started to have a heightened rate of defaults, or maybe even a sovereign default, then suddenly we'd be talking about a whole new scenario, because Turkey has a lot of corporate debt and a lot of leverage. And I'm just using Turkey as one example. There are many others in emerging markets. And I did a whole video about this going into this crisis. Anyway, so yes, I'm still concerned, I'd say. So back to the questions. Great question, by the way. Peter says, hi Ramin, VWRL or Vanguard Ftse Global All Cap, looking to invest and forget regularly with savings for 20 years plus for retirement. Thanks for the videos. My pleasure about the videos. So VWRL, I mean, we can take a look actually. That's probably the best way to do this. So I guess what you're asking is which one is better, VWRL or Vanguard Ftse Global All Cap. Now, I'm not going to advise you which one's best, but what I will do is show you my thought processes if I were to be considering these two funds. So let's have a look at Vanguard's description of VWRL, and then we'll look at Vanguard All World. All Cap, isn't it? All Cap Index ETF, I think that's the one. All Cap Index Fund. Just check that's what you're asking. Vanguard Ftse Global All Cap. Yeah. So these are the two you were talking about. So let's just think through those two potential funds. So the first thing I'd look at is where it gives me exposure. So Ftse All World is, let's look at the countries first of all. So 59% is North America, so that's the US and Canada, 17% Europe, and 13% Pacific, 11% emerging markets. So it does give you access to emerging markets and developed markets. And it has a very large US allocation of 56%, and Japan 7%, in line with market cap. UK is only 4% because the UK is 4% of global equity markets, with a very long tail of smaller countries here. And then if we look at the sector breakdown, you can see that, yes, it's in line with global tech allocation, which is about 22%, consumer discretionary 16%, financials 14%, and so on. And so you know roughly what you're buying there. I mean, I'm quite familiar with global indices, but if you're not, then have a look at that. Another thing to consider, the first thing I'd look at actually would be the fee. So the fee for this one is 0.22%. Now, for a global equity index, that's not unreasonable. It gives you access, it actually buys 3,470 stocks, so it is very well diversified. And let's look at the distributions. So that's the dividend which has been paid out. So it's paying you about 1.5% dividend, and it's paying this out on a quarterly basis. It's March, June, September, December. So this quarterly dividend yield will be the amount of money paid out over the last 12 months. So it'll be trailing. It'll look back over the last 12 months. It'll add up all these dividends and divide by the price of the fund today. In other words, the dividend yield is how much money was paid out divided by how much you had to pay to get that, how much you'd have to pay today to retrospectively to have got that payout expressed as a percentage. So if that stays the same, if you invest £100 in this fund, you'd get about £1.50 in the 12 months ahead. Of course, it does vary, but for a global fund, it won't vary hugely. So those are the things I'd be looking at. So now let's look at the Ftse Global All Cap. Now notice it says All Cap here. So this one is not an exchange traded fund. So it's not an exchange traded fund. It's a mutual fund, an open-ended investment company is what it's called. And but if it gives you exposure to the All Cap index, that means that it also buys small caps, mid caps and large caps, whereas this one probably is much more weighted towards large companies. This one deliberately includes small caps. So it has more stocks in it. It has over 6,000 stocks, almost 7,000. The ongoing charge is a little bit higher, 0.23, perhaps because if you trade small caps, you're going to have a larger cost, bigger bid offer spread. So that's why it's slightly higher. And then if we look at the actual portfolio data, we can look at the country allocation, which is kind of similar: 57% US, 7% Japan, UK 4, China 5. And if we look at the sector composition, again, fairly similar, but in this case, it's going to have more small caps. So if you are investing for the long term and you believe that small caps outperform long term, and remember, this is one of the first Farmer French factors, small caps beating large caps, then you might expect this fund would outperform the FTSE All World. So those are the kind of considerations. Let's have a look at the distributions just quickly. 1.5%. This one is an accumulation fund, whereas the previous one was an income fund. So for an income fund, you're paid cash payments into your bank account, into your brokerage account with Vanguard or whoever it is. With an accumulation fund, it's reinvested back into the fund, any dividend, which is more tax efficient probably, and certainly more time efficient for you because you don't have to reinvest it. So that's another difference between the two. And my preference would probably be for an accumulation fund because I can't be bothered to reinvest those dribs and drabs of cash as they drip feed into my account. So, personally, I'd probably go for the all cap one because it's accumulation. It has small caps in it, and I don't really care if it's an ETF or a fund because usually I don't trade much. I probably hold it for a long time, could be years. So whether it takes 2 days to trade or 1 minute makes very little difference to me. So those would be my considerations. But as I say, I can't advise you which is preferable. You have to make up your own mind. But those are the kind of attributes which I'd be looking at, just so that you can maybe apply those and weight it according to your preferences. Okay. Siramis, hello, nice to see you. Andrew Lester, I really like the show, learning a lot. That's great, that's our goal. How long should I leave it before deciding to switch from a badly performing fund? 3 or 5 years is often mentioned. Well, if you like the fund, you shouldn't switch at all. That's the point of having a long-term goal. What you really want is to choose a portfolio you're happy with and stick to it pretty much forever. If you try and chase a fund which is performing well, or you read an article in a newspaper that says, environmental funds are very hot this month, and then you suddenly rush out to find the best performing environmental fund, that's not a great way to invest, and usually you won't perform particularly well. The people who perform best would be the ones that do diversify, obviously, but you'd go for particular funds which you're happy with and which suit your investment style. So if a fund is hugely underperforming, there are a couple of questions you should be asking, which is, has the investment thesis changed? Is the reason why you bought it in the first place no longer applicable? Or perhaps the fees are high and perhaps it's an active manager, in which case maybe that's why it's underperforming. Sometimes active managers look good for a while, but then, they go, they change their investment method, like Woodford did. He started off with a certain investment style, then he completely changed it with the Woodford fund. Or, there are lots of reasons why an active manager might start underperforming. If it's a passive fund, then the style of investing may no longer be suited to your investment appetite, your risk appetite, for example. There are a whole bunch of reasons why you might switch, but just because it's underperforming is probably not a good one. But I 3 to 5 years, I suspect you're talking about active funds, in which case, that actually would be a reason to buy the fund, because an active fund which underperforms 1 year may outperform the next. No active manager can outperform every year. So, maybe the fact that they've just had an unlucky break for a given year, and they could still generate alpha, they could still outperform the index, outperform the broad market, but maybe they just had a bad year. So yeah, I'd be really careful about switching just because the price has gone down.
Like?
Yes, please like our stream. It helps us a lot.
Share.
And share the stream, because then other people will know about it and they'll benefit from watching it. So yeah, please do that. It helps us a lot. I'd appreciate it. We currently have 176 concurrent viewers and only 49 likes. So something's not quite right there. Please do like it. I'd really like it if you did share and like the stream. And also, you can now join us you can now support us on YouTube. You just click on the join button. If you're watching on a PC or a Macintosh, there'll be a join button underneath the window in which we're streaming. And then you can become one of our supporters. And we'll see by your name a little crown appear, a beautifully designed crown. And yeah, that would help us a lot, and it'll keep us independent. Next question. Richard Scott. Hi, Ramin. Very good. My name's actually Ramin. It's funny though, because American people always pronounce my name Ramen because they have noodles there which sound like ramen. Yeah, anyway. Hi, Ramin. From a Tier 3 West Yorkshire. Yeah, I think we're Tier 3 now as well, aren't we?
So,
Very soon.
Yeah.
So in Amersham, in Buckinghamshire, on Friday, we will join you in Tier 3. So solidarity from the Amersham group. Tricks and here we go. Tricks and tracks. Evening, Ramin. If active management stock picking doesn't beat the market, why might you do anything else but a life strategy fund? Yeah, I mean, some people, it depends on asset allocation, right? So asset allocation is how much you put into every asset class. So if you go for a passive fund, let's say a passive bond fund, a passive equity fund, then you can always rebalance. So that generally improves your returns, because when equity markets fall, you sell some of the outperforming asset, which would be bonds, and you'd buy equity. And if bonds outperform equity, then you buy equity at a cheap price. So that's why it's always better to have a little bit of flexibility sometimes. For most people, I think, yeah, it is much simpler to just have one fund. And But if you do want to have the extra flexibility, and here I'm also talking about another form of flexibility, which is, let's say that you're in retirement and you've already started drawing down and you want to increase your equity allocation over time, but you don't want to sell the equity in your portfolio because you know that will outperform over the next 20 years of retirement or 30 years of retirement. So what you do is you sell the bond part. Now, if you've only got life strategy, you have to sell the equity and the bonds together. Whereas if you have the two separately, then you can sell the bonds rather than just the bonds and the equity. So there are a whole bunch of reasons why some people prefer to have that extra dimension, which is having multiple different funds. So you can still be a passive investor and have multiple funds and benefit from the low fees, but you don't necessarily just have to have one fund, is my point. So yeah, sometimes you want to do that. Another reason is you may not like the weightings that you get for life strategy. So there's a big UK overweight, and I did a whole video called Portfolio Inspiration. And if you just Google that, Portfolio Inspiration Pension Craft, you'll see it. And I showed how to reproduce the returns of life strategy using either other Vanguard funds or iShares funds. It turns out the fee is much lower. So you can have Vanguard-like returns for half the fee. You have to do the rebalancing yourself once in a while. That's the drawback. But you can also tweak the weights. So if you don't like the UK weighting, the 6-fold overweight for the UK in life strategy, just dial it down. If you want a bit more emerging market, because you think China's going to outperform, then you can just boost that a little bit. So some people just like to make those adjustments. You know, one size fits all doesn't work for everyone. Right. Ivan, good evening. Will US long yields go negative? So let's have a look at US long yields. Let me share my screen again. So let's look on Fred. US, well, let's look at the 10-year first of all. So this is the 10-year constant maturity yield. And currently that is gradually rising. I think it reached a low point in August, maybe a bit earlier. So it went down to 0.52 in August, down to 0.54 in March after that big equity sell-off. But currently it's at 0.92. So it's gradually increasing. Let's look at the 30-year. So 30-year Treasury constant maturity rate. So there we're looking at what? We're looking at 1.65%. Now in real yield terms, so 10-year, so if we do take inflation into account, 10-year real yield, yeah, so that will be the real yield. The real yield, which is inflation adjusted on inflation-linked bonds in the US, is minus 1%. So that's actually getting more negative. So it really depends on whether you adjust for inflation or not. So it's already the case that you get a negative real yield on 10-year US government debt. But the question you were asking was about whether long rates were going negative. But you know, I think it's unlikely given where they are now. Because remember that what drives long-term yield is things like growth expectations and inflation expectations. Inflation expectations have risen slightly. If you look at the market-based measures of inflation, they have risen slightly recently, but it's still not crazy high, and it's still below the Fed's target, which is the average target is now 2%. So I think it'll take a long time, or it'll take a massive shock, a growth shock, another one, to, let's face it, 2020 is full of shocks. We've still got 2 weeks. I mustn't jinx it. But we could have another shock, a growth shock. which would mean that yields would fall if equities were to fall as well. So if we had another equity market crash, that could push yields down again. But I don't think it's going to happen anytime soon. It's unlikely, particularly at the 30-year end of the curve. Maybe at the 10-year would be more likely, but still fairly low probability, I'd say. But even if it does, you still get a positive coupon. It's just that the yield to maturity is negative. And if you do want to learn more about that, I've got a whole course on bonds, which is available on our website, pensioncraft.com, where I talk about how yield works and all of that good stuff, the bond maths. Okay. Anton says, good to see you again. Good to see you again, Anton. Alain, hello. How are you? Good to see you as well. Kenneth Adams says, hi, Ramin, and many thanks again for doing these. With fiat currency possibly devaluing due to QE and bonds, etc., not looking too attractive, where do you think a good store of holding wealth is, please? Well, I'm not convinced that fiat currency is devaluing a lot. If you look at inflation, which is how you measure the loss in purchasing power of currency, in the US it's currently very low. Something like, from memory, in the US it's something like 1.2%, I believe, is CPI inflation. And no, I don't believe that it's measured incorrectly. I do believe that the CPI measure is a pretty good one of the cost of living. Obviously, there are some subcomponents which have gone up a lot more, such as healthcare in the US and education has gone up a lot in the US. But remember, the consumption basket is based on an average for the typical consumer. So it incorporates all of those expenses. So that's why, at the moment, there's not a huge inflationary spike, which a lot of people expected because the Fed's printing lots of money. It just hasn't happened. It's worth watching to see whether it will happen. If you listen to Jerome Powell yesterday and the videos on YouTube, you can watch his FOMC meeting, his kind of press conference. He certainly doesn't see inflation. He doesn't see any significant signs of inflation yet. And let's face it, the Fed has an army of economists looking for inflation. One thing they are good at is looking at inflation. Not so good on the crises, but good at looking for inflation. And they just don't see it. So I don't agree with your first premise, which is that fiat currencies are devaluing a lot. They're just not. And in the UK, inflation's about 0.7%, even lower. So I think cash is a pretty good store of wealth at the moment. I think government bonds also a pretty good store of wealth at the moment. I don't think things like Bitcoin are a good store of wealth at the moment because it's so volatile. It has a volatility of 70%. So I don't think that's a good store of wealth. If you are worried about things losing value, if inflation does spike, then cash is obviously terrible. Government bonds, long duration government bonds are terrible. Shorter duration government bonds, not so bad. And gold would probably be good up to a point. But gold isn't a great inflation hedge, I have to say. In that case, I'd go for something like inflation-linked government bonds because those do keep their value. By definition, they're designed to keep their value and to keep in line with inflation. So that's probably the best store of value if you get very high inflation. If you get deflation, then cash looks attractive. Long duration government bonds look attractive. Normal bonds. So those are your choices, I think, because they're very liquid, large markets supported fully by the government and the central bank. So those are the ones I'd probably consider. Paul Stitson says, good evening all. Good evening, Paul. Leo says, hi Ramin, if an ETF and OEIC, open-ended investment company, track the same index and have the same ongoing charges figure, which would you choose for long term? ETF has added cost due to spread. Yeah, I think, well, the added cost of the ETF due to the spread is only if you trade it a lot. So remember the bid offer spread on a liquid ETF will be very small. It'll be like the bid offer spread on an equity, unless there's a market crisis. So, that's just a one-off fee, whereas the ongoing charges figure is forever. That's why that matters more. So I personally, I just wouldn't feel strongly either way. I'd be fairly indifferent as to whether I'd go for the ETF or the open-ended investment company or the mutual fund. If you do need the intraday liquidity, I'd go for the ETF, obviously, because that trades during the day. What I don't like about some mutual funds is that they have multiple share classes, and I think that's quite complicated. Another thing I don't like is when they give you a special fee for a certain platform. Oh, look, we've given you this discount on our platform. Well, then I'm going to be locked into your platform. I don't want that, right? I just want the same price as everybody else. I don't want to have to worry about which platform I'm paying my fee on. So that's why I don't like mutual funds. It's the share classes. It's having different fees on different on different platforms. I just don't want that. So that's why I probably go for the ETF, because it's the same fee on every platform. But really, I wouldn't feel strongly either way. If it does what I want and it's got what I want inside it, then I'd be fairly indifferent. Tom Peachy says, hey Ramin, what will cause the Tesla bubble to pop? I have a short on, but it keeps going up. Oh no, that's the pain trade. That's unfortunate. There was an interesting article on Twitter today, which was talking about options, and a lot of people have been buying Tesla through options, call options, and because it's going to enter an index, the S&P 500, then there'll be lots more arbitrage trades you can do, which will create efficiencies in the market, which will mean that if the volatility on Tesla call options gets too high, then you can do an arbitrage trade of that versus the index, for example, which you couldn't do before with any hope of them coming back into line. So I think a lot of the large institutional investors, so those are the hedge funds and maybe some of the pension funds and insurance companies, maybe they can do these trades, these arbitrage trades, which bring the pricing back to sanity, particularly in the options market. You can also, to some extent, do that for the S&P 500. Remember, it's only going to be 1.5% of the index, but yeah, maybe becoming part of the S&P will normalize it, in which case it has a long way to fall if it comes back into line with fundamentals. So, maybe that'll be the catalyst to pop the bubble. But the EV bubble is I'm almost certain that that's a bubble, that market, because the valuations are just crazy. Obviously there's euphoria and there's huge buzz in that sector, and it is the future. I agree with that. But I think the valuations ultimately have to come back into line with sanity. When it'll happen, I have no idea. And I just hope your trade works out, Tom. But yeah, that is a pain trade. Thank you, Elaine, for pointing out that video. And the Ray Dalio is wrong one. Thank you. Nicholas says, hi, Ramin. Remember, if you do a super chat, you'll go straight up to the top and I'll answer your question straight away. You have to pay for that, but I will answer it straight away. Please do like us, I should say as well. We've got 100 likes now, 98, and we've got 262 consecutive viewers, and we still have 22 minutes to run. And my bake is actually proving in the oven while I'm doing this. So now I've discovered baking. I've discovered that I can also prove my bread at the same time as I do a YouTube live, which is great. Quick answer for Jazz Rhodes. Great name. Why is Linux the OS of your choice, Ramin? I just like open source software. Always have done. And Laura's not quite so keen. She calls Ubuntu Umbongo, which I think is frankly disrespectful.
The soft drink.
Yes. Right. So Yes, so Nicholas says, do you consider appropriate to reduce equity currently when market seems overvalued? It's not an attempt to time the market. What's the difference? Thanks. Well, if you rebalance your portfolio, and remember there was a question earlier about, why would you ever choose to split your portfolio as a passive investor away from a one fund portfolio as a life strategy, for example, to something like, bonds and equity? Well, this is one reason. So let's say your long-term weight for your portfolio is 80% equity, 20% bonds. Then just by rebalancing, if equity gets ahead of itself, the weights in the equity component of your portfolio will go up. So maybe 85%, the bonds will go down to 15%. So just by rebalancing, you'll sell some of that frothy equity at a high price and you'll buy the bonds at a low price. So just rebalancing is a natural way to de-risk and to lock in some of your gains. How often should you do that? Well, usually if it drifts away from your strategic long-term weights by a certain percentage, maybe 5%, maybe even 10%, that's the time to rebalance. Or in your case, maybe if you get nervous about equity being overvalued. But, these things are very difficult to call, and equity can remain overvalued for a very long period of time. Just look at the CAPE ratio, you'll see, equity can remain in bubble territory for a very long period of time, maybe years. And, just goes to egregiously high levels, and then some trigger happens and then people capitulate. They realize that this is a frothy market. Paying too much for equity is not a good idea. People remember valuation does matter. It always matters eventually, and then you get the correction. So it is kind of timing the market if you sell equity because you think it's too high. I did it in February. I sold in February half of my equity before the sell-off, but it's not a good idea to do that. That's why I always say don't do what I do. Stick to your guns and don't change your portfolio massively. Just keep on investing. Because remember, the way to get rich in investing is to save as much as you can. Don't expect your investments to do the heavy lifting. The best thing to do is to save as much as you can. That's the best way to maximize your retirement returns. People don't get rich from, small amounts of money. A can of Vimto and what was it? A can of Vimto and let's see what the comment was. Can of Vimto and 2 bounties. There we go.
Not 2.
2 bounties. It was 2. There we go. James Gardner says, wondering if you could give some insight on the following topic. To my mind, the 2 key choices on Vanguard for a fund tracking the total global stock market are the global all cap index. I kind of did answer that one. Fund and the VWRL ETF. Well, we did, didn't we? Oh, you're talking about the tax perspective. The index fund is UK domiciled, but the ETF isn't. Yeah. It's Irish domiciled. Yes. Interesting question, because it's not absolutely clear what's going to happen to the withholding tax after we get Brexit, but also the passporting of financial services. Whether we're going to respect the passporting. I expect we will. I think if you look at the FCA and also the Bank of England, they have done various documents where they talk about what's going to happen after December the 31st. And I believe what's going to happen is we'll allow Europe to passport their stuff into the UK, but the reciprocal relationship may not be true. There was an article about this on CityWire a couple of weeks ago. So I'm not sure what's going to happen, to be honest. I don't know whether there's going to be a difference after December the 31st. But we'll just have to see. Oh, we've got a live chat. And what is it?
Thank you.
iTurtle HD says, would you recommend an all-world index fund over the S&P 500 index fund for long-term investing return? So what we're talking about there is, effectively what we're saying is, will the US continue to outperform relative to the rest of the world? Now, normally what happens is, if you look decade by decade, which country outperforms, it does flip. Now, the last decade was the year of the US, no questions. They by far outperformed any other region on the planet. Will that be the case in the decade ahead? Probably not, if history is anything to go by. So, going long the S&P 500 and sticking with that over the coming decade may not be the way to go. It may be better to diversify, because then at least the winner will be in there somewhere. And remember that the S&P 500, the US, is more than 55% of the global equity indices. So effectively, you're very long the US anyway. So going the whole hog and being 100% US equity is even more extreme. But you may be unlucky in the years ahead. And it's always it's just one of the cognitive biases that we assume that the future will resemble the recent past, but that's often not the case. So just look back over a longer period, and you'll see that other countries have come to the fore much more, not just the US, for example. So the US has had a great decade. It may not have another one in the decade ahead. Good question, actually. Yeah, I like that. Okay. Good question. RM80. Ramin, do you consider all those years you spent learning physics a waste of time? No, not at all. Not at all. Because, firstly, it gives me a richness. Whenever I just see a droplet of water on a plant and it refracts the light, I've got a really deep understanding of that. Or if I see a rainbow, and I think that gives you a kind of richness which you just don't get. Plus, while Pensioncraft's income was building up, I made my money tutoring physics and maths. I was teaching A-level, O-level, GCSE students, showing my age there. I was teaching them physics and maths, and I loved it. I absolutely loved it. And it honed my teaching skills, which I'm using at the moment. And a lot of the stuff I learned in physics, I'm using right now. I used it in investment banking, and I used it for Pensioncraft. So when I calculate returns, when I calculate correlations, that's based on a lot of the mathematical knowledge which I picked up when I was working as a physicist. And the things like the Scooby-Doo tree, where I look at correlations and I plot it as a tree. Again, I learnt that when I was doing my PhD in biophysics, when I was learning about how to align DNA sequences. So a lot of that stuff is similar to the knowledge I had in physics. So I've never regretted the physics degree, quite the opposite. And the PhD as well, because I learnt about molecular biology, which has been such an interesting thing. So no, not a waste of time. Absolutely loved it. Happy Christmas from AT. What financially oriented change would you wish that Santa would bring? Oh, what a wonderful question. Well, I'd like Santa to have more fiscal stimulus, because I think a lot of people are suffering unnecessarily because they've lost their jobs. And remember, this recession was not due to any fault of their own. It's not like people were lazy. It's not like they're incompetent. It's because their business was shut down by a virus. And it's usually the poorest in society which had that impact. So it's the service level jobs which have the lowest incomes. So that's what I'd like from Santa. A little bit more of a equal recovery for all of us. And yes, we're going to have to shake the magic money tree in order to do that. But as we've seen, you can do that without a catastrophic consequence, as long as you don't go crazy with the debt. As long as it's still sustainable, as long as the growth of the debt is less than GDP. So that's what I'd like. I'd like a fiscally responsible Santa across all the world. That would be great. Isn't that right, Ted? Yes. Fiscally responsible Santa. Yes, Ted would like that as well. Yes, and as Elaine says, physics and maths are very much related to financial markets, especially stochastic processes and chaotic motions. So it's never a waste, in his opinion. I agree. When I first saw about how to price derivatives, the equations which are used to do the Black-Scholes pricing are actually the same ones as you'd use when you're talking about diffusion in physics. So diffusion of heat along a bar or various other processes, but if you heat up one end of a bar and the heat flows through the bar, it's actually very similar to the equations you get to price an option, which is kind of weird but interesting. So when I first saw those equations, I thought, oh, that's weird. So it's never wasted, never wasted. Okay, what's your opinion on Pershing Square Holdings entry into the Ftse 100? Do you think its 3% fees are justifiable and present a good opportunity? I don't think 3% fees are ever justifiable, so no. But, you know, the Ftse 100 is very much weighted on market cap, so I think that's the reason why it went in, because it's big. But otherwise, don't feel strongly either way. But 3% fees, not really. Okay. Do you have any thoughts on oil prices and Shell? I'm trying to work out when to sell. I bought cheap, but don't think oil is something to hold forever. So let's have a look at the prices, because I think that's always useful. So let's have a look at the price of oil. And so let's look at WTI, which is a good measure of the oil price, and we'll give it a bit more history. So this is the entire history of oil since 2008. And when there's a recession, you can see that the price of oil falls. It happened in 2008. Then it recovered. And it took about, I think that's about 1.5 years, maybe 2 years to recover. And then, you know, obviously we've had it fall again. And it's recovered much more quickly this time round. And of course, this is driven by lack of demand. But it has recovered a lot. And it's still not back to where it was. And yeah, I guess we could look at Shell as well. So Royal Dutch Shell. Here we go. And this is their share price. And we'll just look at this year. And you can see it's not exactly tracking the price of oil, but it has recovered a lot off the bottom. So if you do think that the energy price is going to improve, then if you're a contrarian investor, this still represents something of an opportunity, but there are many other things you'd have to consider, in particular the amount of debt which the company has. So if we look at the balance sheet, you'd probably want to look at the size of the borrowing, how much it's been increasing, and you can see that that's been increasing fairly steeply. There was a big jump up in 2016, and so you probably look at the ratios, you look at the enterprise value to debt. So the enterprise value to EBIT, for example. So that's 6.4. So from 2019 to 2020, it went up, obviously because the revenue fell, the EBITDA fell. So there are a whole bunch of things you might want to consider. The dividend is still fairly high because it's still paying a dividend, and it's paying 5.5% in 2020 because obviously the price has fallen and it's carried on paying a dividend. But then you'd also consider about how much cash it's got in reserve, and you'd probably look at how it sits relative to the other companies in the sector. So lots to consider for single stocks, which is why I never do it. But yeah, I think energy is going to improve. I think the price of oil will increase because demand will increase once we get a vaccine and once we move away from this crisis. So yeah, I think oil prices will improve. And if it's anything like the 1918 flu outbreak, 2 years afterwards, maybe even a year and a half afterwards, there was a second wave. But a year and a half afterwards, things were pretty much back to normal. So I suspect we'll see something fairly similar this time around. So I think there still could be upside for oil, but it is very volatile, and we could get second waves. The vaccine could prove to have a low uptake because there are anti-vaxxers out there, or it could mutate in the emerging markets where they can't afford vaccine. Perhaps there'll be a new strain which mutates, which is resistant to the vaccine. There's a whole bunch of stuff that could go wrong. So, it's not without risk betting on rising oil. But, I think there's still upside. Would I do it now? I can't really say. I mean, personally, I'd stick with it. But I'm not a single stock guy. I'm not the guy to ask. RM80 says, it's relevant to me because I have 2 kids about to start university and I don't want them to spend years and lots of money on an education if they're not going to use it. This is talking about physics again. Yeah, I think physics is never a waste. Other degrees, perhaps. I won't name degrees, but chemistry. But yeah, depends on the degree. But numerical degrees, numerate degrees, where you kind of learn maths and problem solving, really useful. There's a whole bunch of things. When I used to work in investment banks, there were loads of physicists there. So, you can become an accountant, a management consultant. There's a whole bunch of things you can move into. You don't have to necessarily do physics. Right, how are we doing? We've got 4 minutes. So please like us. We've got 300 concurrent viewers and only 137 likes. That's surely not right. Quickly, I shall whip out my cockapoo to help increase the ratings. Now, you're not going to be sick, are you, Ted? No. Good. Okay, so please do like us. 137 likes. Maybe we can get that up to 200 before we finish. That would be great. And yes, please do like us. And remember, you can join us now. You can support us on YouTube because we have a YouTube support. Oh, I forgot. What am I supposed to say, Laura?
Just support us on YouTube.
Support us on YouTube is what I'm supposed to say, because you can now, which would be great. And yeah, you can always join us on Patreon. So patreon.com/pensioncraft, and you get access to all of our content, which is only for members. Yes. Let's move down. Cameron says, do you think a minimum volatility equity fund can ever be a partial substitute for bonds in a portfolio aiming to reduce downside risk? Yeah, touchy subject, because Vanguard has shut down the minimum volatility fund on their website. But yes, it is bond-like, but it's not a bond. And in fact, there was a video I did critiquing Bridgewater's views about bond alternatives. So some of the things they suggested was going to emerging markets. So Chinese bonds still have a fairly high yield relative to developed markets, but there you've got currency risk, EM risk. So I don't think that's a really good substitute. Equity obviously has a high volatility, and if equity sells off, all equity sells off, minimum volatility or not. Minimum volatility may sell off less, but it'll still sell off. There's no way it's as good an equity hedge as government bonds. So I don't think there are many substitutes out there which are convincing. What Bridgewater suggests is looking for companies which have fortress balance sheets, which won't sell off in an equity sell-off as much as others, and also have low volatility. So yeah, I don't think that's a great substitute, but it's an okay substitute. But I don't think you need the substitute, put it that way. What's your Keith Wallace says, what's your thoughts on Chinese index funds over the next 3 to 5 years? Interesting and topical question, because I don't know if you've heard of Perth Toll, but she runs the Freedom Index funds, where she weights not by market capitalization, but by how free a society is according to a certain set of definitions. And she has very low Chinese weighting as a result. But personally, I think Chinese equity is going to have quite a bit of upside for a whole bunch of reasons. I mean, I agree with a lot of what Ray Dalio says about China. Loads of numerate graduates, so a huge number of numerate graduates which are coming out of their university system, and those people are going to go off and innovate. Not all of them, but some of them. And also now we are seeing a lot of value-added industries, very high-tech industries. Look at the EV cars which are coming out of China now. They're just very high quality. The time when you could look at Chinese products and think they were low quality is long gone. Plus, they're a service-driven economy now, and they have a lot of momentum in terms of their growth and also their ability to fund that growth. My concern is about the credit problems, which may cause a problem later down the road. But apart from that, it looks pretty good for China at the moment. So yeah, I think there's a lot of upside for that. So personally, I'd go for, a lot of China, a lot of US, and Europe I'm less convinced by in terms of growth. But, I don't make recommendations, but those are the two regions which I think have a lot of upside. And then ultimately China, Africa, but that's a much longer term play. Yeah. Harold, I'm sorry I didn't get to you. Cute dog, somebody says. That's Belle Canon. Thank you. Thank you from Teddy. Yes, so I'm afraid I did run out of time. Remember, if you are a Patreon supporter, you do get a much higher chance of having your question answered. In fact, I usually answer all of them on a Sunday evening for the Patreon members. So go to Pensioncraft, go to patreon.com/pensioncraft, and for a very small monthly fee, we get these kind of Q&A sessions for just members. Plus you get access to Slack, and you can chat to me and other people anytime. And you get access of all of our backlog of video explainers, which is now pretty immense. And it covers a lot of topics. I just shot one today, for example, talking about currency hedging. So yeah, please do join us. It would be great. Support us, like the stream, subscribe to us on YouTube, because a lot of our content is given away free, but we can't do that unless you support us. So please do that, and have a great Christmas or holiday. If you're not Christian, then have a great holiday, spend time with your family, don't think about investing, just enjoy yourself, and come back to this hopefully a better year in 2021. So have a great Christmas, and see you on January the 7th. Thank you.